Okay, very good morning. Welcome to the briefing for Friday, the 25th of November. Just taking a quick look, get you up to speed with the markets post-Thanksgiving. Obviously a very overall quiet day yesterday. Did see a little bit of movement in really the currencies of some of the main moves that we saw during yesterday morning, as then things, as expected, started to die down in the afternoon. But looking at the state of play from this morning, a bit of pressure coming into the DAX future in early trade. A reminder, I would say, if you're looking at your pivot levels today in both the futures and CFDs, they might look a little off, just given the fact there was no floor trade in the US yesterday. So just the way that the pivots get calculated is supposed to be on the closes, and so they might look a little odd today. So just be aware of that. But some pressure in the DAX. There's really, putting together a couple of things to talk about for the briefing. There's just not a lot of news going on at this point, which is normal with Thanksgiving. If you think about it, even the journalists in the US are on holiday as well, so the news flow does tend to die down. But pressure on the DAX, we have seen in Italy this morning. In Europe, Monte Paschi shares halted, limit down once again within a few minutes of opening, after falling 5.5%. Now, that might sound quite punchy as a number, but, well, average price movement in Monte Paschi in the last few months, I'd probably say 5.5 is about average. They tend to be one of the most volatile stocks in Europe. But sentiment-wise, it does make a bit of sense in towards the way the market is moving this morning. That coupled with likelihood of lower volumes just helping exacerbate some of the price action as well. So when we started to move lower, probably a few people just catching some of the momentum to the downside. Yesterday's low probably looks a significant level of support down at 10,648.5 in the DAX. So I'd be watching that. We've already started to see a bit of a bounce here though, a more recent trade. The reason why that support might be quite solid, just given the fact that there's no real other fundamental reasons for it to push any lower, given the news that's occurred in the last 24 hours or so. Sticking with the Italian theme though, because if you look at it, you have equities moving a little bit to the downside in Europe, and you've got gold, which has seen a pretty nice bounce overnight in Asia, having declined. Well, look at overnight. First of all, you had a big drop in prices actually during early Asia Pac trade. We fell all the way down to around 1170 before then recovering, and we've moved about $20 since the overnight low to where we are at the moment. So we're back to, on the session it's flat, but 1190, so recovering some of that break of 1200, which has put prices under pressure. But low equities, Italian banks seeing some pressure, gold rallying, and obviously this does lead us into the kind of next risk event, if you like, which is the Italian referendum looming. You're starting to see more and more people talking about this as the clock is ticking. Well, let me first of all show you this. This kind of encapsulates then some of the general risk in people's view of the potential of political uncertainty being heightened because of, like we've said before, Renzi, the PM, has pinned his political fate on the back of his reform push being successful. And if that is not, and it goes against him, then he said he would resign. And so increased or renewed political uncertainty in that country is something which has been fairly common, but they've had a bit of consistency in that regard more recently. But this, of course, comes amid other things. So first of all, just to explain what this is the Italian 10-year risk premium over Germany. And you're probably going to hear this talked about a lot in the press. This is the benchmark 10-year bond yield of Italy, or whichever European nation, France we'll be looking at as well closely, against benchmark Bund yields. So it's kind of the metric being that the wider the yields move far apart from each other, i.e. the yields and the risk premium rising in Italy and France as we get closer to those political events. The German one remains stable, the spread widens, widening is negative for sentiment, and in terms of probably euro currency and so on. The opposite for tightening. Let me just bring up, I've just seen an article here just flash up. It's quite a good picture, I guess, from Renzi. He's kind of the general feel, I guess, of most politicians at this point. But the clock is ticking, certainly. I'll post this into the chat room. This talks about a couple of different things, because actually what we're heading into is a super central bank December, because you do have the Italian referendum will come a week ahead of two potentially major central bank meetings. You've got the ECB, then the Fed. So you've kind of got a clustered, let's say, the first half of December. Before then, I can assure you things will likely get very quiet into the Christmas period, as they often do. A couple of things the FT are looking out. Watch banks, not bonds. Any immediate financial stress from a no vote is likely to be seen in Italian bank stocks rather than government bonds, according to Goldman Sachs. Again, as I said, those Italian banks tend to be extremely interest rate sensitive and politically sensitive, so they could be ones to watch going forward. Spain and Italy. European government bonds have endured a tough time in the wake of Trump's election, sparking fears over rising global inflation and concerns his victory could embolden Eurosceptic populists in Europe. According to Goldman, they think Italy will remain a riskier bet than Spain for bond investors following a no vote. I mean, I think that's a bit of a no-brainer. But both Goldman and UBS expect Italian government bond yields to stay above Spanish equivalents after Madrid broke a near 12-month political deadlock. So you've kind of got the opposite situation if you're looking at those two southern European nations specifically, which have always been kind of clubbed together, as in Italy and Spain politically, now are starting to see some divergence, because you've actually managed to muddle together a little bit of a stable situation in Spain comparative to the looming risk in Italy. Other things after a yes or no vote, shades of grey. Italian GDP growth forecasts obviously are looking far from healthy at this point. The other chart to look at obviously is the same thing, looking at the French-German 10-year government bond yield spread. And you can see that over really since the beginning of this month has really shot higher, because of the fact that we thought pre-Trump that Brexit may have just been a one-off event that's happened in Great Britain, Middle England. The protest vote won out, but what's becoming more apparent with the Trump election and him being victorious is that this populist movement is becoming more of a global phenomenon, and as such people have now grown more fearful that although National Front's Le Pen is unlikely to become the French president, I think people are giving this more and more emphasis now, and prices are already moving in and building expectation on a credible chance that she could now win. However unlikely that is looking in the polls, but the polls obviously have got things wrong multiple occasions, which makes people very nervous. So looking back at the charts, obviously gold then, for those reasons just discussed really, we've said at what point do you start to think about re-entering gold, given this devaluation that we've had since we broke 1200, which obviously was a very big level. Well, you can see it here. That was the mid kind of June or late May, early June 2016. That acted as firm support before that powerful move to the upside. That break then triggering quite an aggressive run lower to 1170 we've seen at the bottom. But given these things, it would seem logical that, and also with inflation rising, gold as a hedge with the political uncertainty on the horizon, gold looks like it should have an upside bias from here on out. Moving on, another thing that just from a news snippet that I saw this morning was talking about UK workers facing their worst decade for pay in 70 years. This is talking about, obviously the guys who've been listening to our YouTube channel and our briefings in the morning will know my view quite probably clearly. People calling George Osborne a financial terrorist before the Brexit vote, and actually Hammond's budget is exactly fulfilling all the forecasts that George Osborne said. So turns out the economists were right. But there you go. But what we're seeing now is exactly the same thing, as in now that inflation is starting to creep up. Obviously the way in which wages work, which is real wages, actually Britons are facing a decade of lost wage growth and will earn no more by 2021 than they did in 2008. And so a lot of this is starting to ring true, and I'm sure you've read about Tony Blair's back on the scene, or behind the scenes I should say, meeting up with Osborne and Clegg, talking about he can't return to frontline politics because, well, I guess for obvious reasons. It's kind of there's a lot of people not happy with him, but he's been pushing this idea that actually a Brexit doesn't have to be a Brexit. And the worse this situation starts to get in our own country, and if things start to deteriorate in Europe, in Italy and France, and other elections forthcoming in Germany and the Netherlands and so on, it will just be interesting to see how the UK public starts to react to these sorts of things, when we've already seen with consumer prices rising on things like grocery and white goods and normal consumable goods, is that at what point then do people start to get dissatisfied about how this is going down? And this, of course, is coming all ahead of triggering Article 15 towards the end of March. So quite a lot of things interesting going on in the next few months that will be influential for these negotiations with the British pound. Looking at the calendar for today, though, just moving on, today's going to be equally as quiet, I would say. This is normally what happens, although as you can see denoted on the calendar here at the bottom, the floor, that's the pits in the US, are open, i.e. New York Stock Exchange opens as per normal today, as too does the Chicago pits, but they all close earlier than normal. With that, what I would say is that what normally happens then is that you get the open on Wall Street, and a lot of the business gets front loaded because you're basically chopping 3 hours of the US trading session out of the guys in the US. They don't have the opportunity to trade a full day, so therefore actually I'd probably see more volatility potentially than normal at the beginning of the session, albeit volumes would probably still be very low because most US traders book today off. You probably saw those scenes of the cars and the traffic trying to get out for Thanksgiving. One thing is that people, generally speaking, in the financial community in the US don't come back to work on Friday. They just enjoy the extended period with their families. So that will probably be reflected in prices today. Looking at the actual calendar, though, there is a UK data release at 9:30. We've got UK GDP, so let's just have a quick look at that. Previously, we had the advanced reading. It's the second reading we're going to see today. That came in at 0.5%. That was, I believe at the time, it was 0.2 higher than expected. If you remember rightly, the advanced reading for GDP was stronger than expected, but it was predominantly, if not wholly, supported by the service sector. So what you actually got was, and be aware of this because I think this happened when I was away, because I remember I saw Piers tweet a tweet to the ONS to do a full-on investigation into front running. So, well, let's see. Keep an eye on cable, I would say, between 9:10 and 9:30, and let's see if we see any movement. What I mean by that is you often see a bit of pre-positioning, i.e. front running, for those who may be in the know, and this often happens specifically with data that emanates from the Office of National Statistics, which is obviously UK data. So, but the one thing that happened before here was that the market actually blipped up in cable because the number was 0.2 higher than expected. That was actually very strong. But then when you actually peeled away some of the layers of the data, it was only supported by the service sector, which has obviously been boosted by a weaker pound through increased spending from people coming to the country and spending on restaurants, bars, goods, flights, hotels, and so on. So actually, I would say it was artificially boosted, and the pound actually pulled back pretty quickly. So it will be interesting to see that figure come out and the underlying metrics to see how that's been revised, if anything. So it's coming out 9:30. The afternoon, you've got 1:30 trade balance out of the US, and then the service PMI in the afternoon at 2:45. But again, as well, the one interesting thing was, I don't think data really acts as too much of a catalyst for markets at the moment, because of the Fed is priced at such high conviction rate, 100% for a December rate. But if you remember the other day, it was the US durable goods, which was much stronger than expected, which acted as that key catalyst for actually the day's best price movement. Now, I wouldn't have based that 100% on the durables report. It was just almost the match that ignited the fire, because gold at that point was just teetering on that 1200 level, and when that broke, technically then it took out a big level, stopped trips, and it moved a good $12 in the blink of an eye. So again, if we're technically around very key levels,
next up in 10 minutes,
these data points could act as a bit of a trigger. But otherwise, in more range-bound markets, I'd say these data points are largely insignificant, the ones that at least we're going to see today. Okay, guys, I'm not going to talk much more than that. I'm just going to let you get on. Obviously, just be a bit mindful that volumes will likely be below average. That includes Europe. We did talk about this in a chat yesterday, in that actually, even though nothing has changed in Europe and the UK, even we trade to a lesser degree, because we know that in the broader scheme of things, there's just a general lack of participation globally because of the bulk of the volume that the US provides. And if you were talking about larger institutional type volume, then obviously one of the biggest players is out of the market. So generally speaking, we tend to take a back seat as well. That's not to say there won't be opportunities at play. So obviously, we'll hope to finish out the week on a firm footing. So enjoy the session, have a good weekend, and I'll see you in the chat.